Good morning, folks. Just getting this episode of Back to the Future started. Hope you all have had a great trading week so far. And one thing I always like to start off talking about just a little bit is risk. I think it's probably the most important part of managing how we survive in the markets over time. If you're not managing your risk, you're likely not going to manage to stay solvent for too long. I see folks making these mistakes a lot. Usually they only learn after blowing up an account or two. My hope is to help you avoid that outcome from ever happening to you to begin with. Now, my own approach to markets has become much more systematic over time. That's been really a winner for me overall. And what I mean by that is I like to use data to drive my trading decisions. So I've developed tools to backtest, to analyze the markets, to show key levels, to show where there's interest in flow and price. And that's allowed me to take a much more data-driven approach. And I'm not saying for those that trade using discretionary approaches that that's wrong per se, but that if you're finding it doesn't work for you the way that you had hoped, there is another way. It's not just winging it, flying by the seat of your pants. It's using data, using momentum in particular to help drive better informed trading decisions. And I'll demonstrate some of the tools and techniques that I use today during this stream. The biggest thing, though, I would say is you've got to learn about what works for you, what works for your mindset, how you're wired. Now, let's take a moment to dive into some charts. I want to talk about a few things that I'm seeing in the markets that I think are worth noting. First and foremost is our good friend, the S&P 500, and we are still trapped in this range. We were thinking maybe the Fed will help to free us from this range if we got, a little bit of a catalyst from that. We did not actually get that catalyst from the Fed. It was mostly back and forth without a break free of this range. We then got Broadcom earnings, which, like Oracle earnings, didn't really make the market happy right after the Fed, and it was kind of a bit of a push in the other direction. So Powell came out with the Fed, and essentially his take on things was, we're going to cut here, but we're really going to focus on liquidity. So instead of focusing on the near-term rates, which you could see in the dot plot, you're only projecting basically a cut or two over the next year plus. The other program that was announced was buying bills in upwards of $40 billion a month to ease near-term liquidity conditions. So the market got its not QE. It also knows that Powell is due to be replaced as early as May, but also that his replacement is likely to be announced in January. Well, that does change things a little bit. And the reason that it changes things a little bit is if you think about it, if Powell's being replaced in May, but the announcement's happening in January, then you basically have a shadow Fed chair, right? That's someone who's going to speak to what they want to do. And it's going to make Powell's plans, his prognostications, less relevant because you're going to have the person who's his successor speaking about what their designs are moving forward. It looks like that might be Hassett, it might be Warsh. It's unclear as of yet, but I do think that whomever steps in that role, it is likely to change the perception of Powell and make him a much less important voice overall for the markets. So that's just something to take into consideration as we get closer to next year. I think it's also one reason that this hawkish cut overall, right? Just talking about rates, not talking about policy here. This hawkish cut really didn't cause too much concern in the market because the market's willing to look past it and say, well, look, we got this bill program. That's helpful. But we also got a new, more dovish Fed chair coming in, and they're going to start talking about what they want to do, and they're probably going to want to cut rates more aggressively. So either way, all of that optimism that might have happened from that realization regarding the Fed was dunked on by Broadcom's margin compression, their earnings not coming in, really their guidance not coming in as good as what the market had hoped, but their revenue growth also was somewhat disappointed to some of the analysts out there. Even though it beat, they were hoping for more from this explosion of AI-driven demand for their TPUs and other processors. And we're not yet seeing it at the scale that the market wanted to see. At the same time, going into this, Broadcom was priced to perfection. All that to say, the S&P is still trapped in this range. We've been here for quite a while. It doesn't look like we're going to be leaving this range without a powerful catalyst. We got non-farm payrolls this morning as well as retail sales. And non-farm payrolls came in better than expected for November, but October was a doozy, negative 105,000. So we're seeing a little bit of a seasonal pickup here. This is what you typically see this time of year because there's temporary hiring. So I wouldn't put too much into today's print coming in, 19,000 better than expected as a seminal event that changes the outlook for the labor market, which is one of, it's time to start looking at it with a little bit of concern. It doesn't mean we're about to roll over into a recession. It does mean we're likely to see continued slowdown in economic growth. That does have a pull-down effect on some earnings. And then the focus on the AI CapEx growth narrative and how it's being greeted with more skepticism, I think that 1-2 combo does set us up for some more risk going into next year. So we might have some seasonality this year. Maybe we'll see the market pick up and start to run over the next 2 weeks. Seasonality would suggest that, although I'll say in full disclosure, seasonality has not been a very good compass this year. So that's what it usually happens towards the end of the year and into the first week of January. It doesn't necessarily mean past is going to be prologue, but that would be my right tail. We get seasonality flows. We get, that end of year kind of everyone's out. So there's not a lot of selling happening. It's mostly passive buying, pushing the market up. We know that SPX 7000 is a really big level that a lot of the larger trading desks are positioned for. So that would be the level I'd look for a rally if we get one towards the end of the year to kind of cap out at. On the other side, however, we do have the lower end of this range. So the top end, we've got to break above 6,900. The bottom end to get range expansion, we got to break below 6,550. Right? We have a pretty decent range here to trade between if you like trading this sort of range-bound consolidation trade. But what's important to note about this is basically a coiled spring. The primary trend is up, so it is more likely that the coiled spring resolves to the upside. But it is a coiled spring, which means there's all this energy that's been pent up for when this range ultimately resolves one way or the other. There's going to be some juicy continuation. So for me, as a momentum-driven swing trader, that's what I'm looking for on the longer time frame. When we zoom into the intraday time frame, it means it's much more likely we're going to see more chop, more intraday kind of noise unless we get a powerful catalyst. Now, let's take a look at the NASDAQ. NASDAQ does not look nearly as good as the S&P 500. I've got to say, this one has me a little more concerned. The NASDAQ had been leadership. It had really helped this market climb off its lows from late 2022, really it's been all about that AI growth narrative. It's also been about Mag 7 earnings expansion and revenue expansion. It's unprecedented what we're seeing with those really large companies. But now we're starting to see more concerns about stretched valuations and whether or not that AI growth narrative is intact here. My own personal view is AI itself has a bright future, but we're marketing it to have abilities that it doesn't have yet. The description from sales and marketing is it's going to take jobs. It's going to, it's going to be able to do anything a human can do. We're very close to that, if not there already. The reality is large language models are basically multiplication matrices of inferred relationships. They're basically probability engines. So that can help with certain tasks, but it's more of a force multiplier, and you've always got to check their work because they don't know what they don't know, which means they're prone to making errors. Even when you give them the best prompt and retrieval augmented generation and all the different kinds of guardrails, they can still hallucinate, they can still make errors. And so I think that the story with LLMs is this is a stepping stone towards where AI goes in the future, but this is not the ultimate destination. And, the sales and marketing people have gotten way too excited about where the capabilities are versus the reality of, what you experience when you use even the best frontier models. That being said, the chart on screen kind of speaks to that. The NASDAQ, unlike the S&P, is not towards the top of its price range. It's actually seeing resistance at what was once an uptrend line. To me, that's concerning. I don't like seeing that from what was our momentum leader. So that's another reason I'm seeing, some reasons to be a little more defensive here. Some reasons that we've seen this rotation into healthcare, utilities, consumer staples over the last, month and a half or so. It's been an on and off trend, but those areas of the market are performing, and it has to do with big fund managers shifting up their allocations away from some of the AI growth darlings and into some of the safer parts of the market. They can't just go to cash. That's not an option for a large fund. So what they can do is they can rotate into presumably safer parts of the market to try to limit downside. And what does that tell you about their mindset right now? It tells you they're being a lot more defensive because they can't just get out of everything. What they can do is they can limit what they perceived to be their risk, which is a mindset of risk management instead of FOMO, where for the longest time it was get as much Mag 7 and other beneficiaries as you can, go overweight. Now we're starting to see them go equal to underweight on those components and go equal to overweight on the more defensive components. And so that's part of that rotation we've seen that set up good trades in some of the dividend paying stocks. Good trades in some of the more defensive stocks. And if you're pair trading, it's set up some fades on growth and some, buys or some bids into the areas of the market that are dividend paying safety areas, essentially. Healthcare, utilities, consumer staples, aerospace and defense, they've all done pretty well overall. Now let's take a look at our friend gold. We looked at this chart last week and we talked about it wedging up. And again, kind of like the S&P being range bound, this one also consolidating over several months and then breaking out. So you had that long period of energy building up like a spring. And when that coiled spring uncompresses, it releases that energy. The path of least resistance is usually the primary trend. So gold suggesting it's ready to continue this march higher. I've talked about $5,000 an ounce gold for next year in the first half. I stand by that. I think we're going to get there. I would like to see precious metals chill out a little bit, maybe consolidate a little more, but they're going to do what they're going to do. And we just have to pay attention to the momentum and capitalize on the primary trend. The trend in gold and in silver is up. It's also up in platinum, palladium, copper. The whole metals complex is on fire. It's been an excellent place to trade. We've actually been really early on a lot of these trades at Traderade and benefiting pretty well from them. And we're seeing signs that they're set to continue. So gold here, we still want to see it break above this prior high on a closing basis, ideally on a weekly close. We may get that as early as this week. If we do, that's yet another sign that upside is favored and significant upside is favored from here. And why? I know a lot of people are going to ask, why is gold in such demand? Let's talk about 3 big reasons. First, fiscal irresponsibility. And not just here, but all over the world. You see governments spending far more money than they take in from taxes. That's called deficit spend. That increases the supply of money. That money is often seeking some way to preserve its value or to get a return, or otherwise, some of that capital is going into gold. Reason 2, monetary easing. We're seeing the Fed turn around. You're seeing some of these other central banks around the world in their cutting cycles, noteworthy exception being the Bank of Japan. But at the end of the day, that helps gold. The idea that the Fed's going to come back in and do $40 billion a month of bill purchases, that we're getting a new Fed chair that's going to be dovish and probably do some things that are a little too dovish on the rate cutting side, all that's very beneficial for gold. Then you have geopolitical uncertainty. And just economic uncertainty. Uncertainty is the key word. Gold loves uncertainty. And if you look back at what happened when Russia invaded Ukraine, what was one of the big things that the West did? It cut Russia out of the Western financial system. What happened right after that? You saw this sort of, I wouldn't call it full-on de-dollarization, but you saw trust in the dollar diminish and central banks buy a lot more gold and do transactions outside of the dollar where they could, just so they could try to ring fence the damage that could happen if they were cut out of SWIFT and the dollar system. So you've got the trifecta, right? Fiscal irresponsibility, monetary easing, and uncertainty across the board. That all helps gold. Then we have our friend silver. Silver has been an absolute beast. I mean, this thing is just, it's in a league of its own the way it's running. And that does concern me a little bit. I will say I would really, really, really like to see silver come in and consolidate these gains, because when you consolidate, you're building support for the future pullbacks that could happen. You're building price structure that is much more healthy for future retracements, which you want to see. I mean, if you're bullish as something, you don't want to see it go straight up. Most parabolic moves, especially in commodities and crypto, they end poorly. So with silver running the way it is, it does make me a little nervous. It is a little overheated. I'd love to see it consolidate or even pull back a bit, maybe come back to this trend line that we've had, and then continue its run. That's not to say it will. Silver has a mind of its own, and you've got to contextualize this move in another way. I'll play devil's advocate here. See, the thing about silver's run is it's been delayed. If you look at the way gold has performed over the last several years, it's like silver has been waiting to catch up. And it's finally doing that. And now it's starting to kind of do what silver does during gold bull markets. It catches up and then it runs further. Same thing you're seeing in a lot of the gold miners, some of the better quality junior miners as well. Rio 2, this is one of the only juniors where I trust the management. And I'm also long. This thing's up like 340% year to date. So that's obviously outperforming gold. Silver's up over 100% year to date. That's obviously outperforming gold. That's what you want to see in a gold bull market. You want to see the miners and silver outperform gold and all of them running together. So there is at least that to offset some of the concerns in silver. But again, I would prefer to see it consolidate or pull back just a bit. Then we have our friend Bitcoin, which I got to say, kind of looks like the chart of the S&P a little bit, doesn't it? The correlation between crypto and stocks has gotten much tighter, and I think this has to do with the liquidity issue that we've talked about a little bit earlier. If you look at charts of bank reserves, if you look at the reverse repo, you look at other measures of global liquidity, you can see it's running on the low side. This is one of the reasons why the Fed has decided to do these bill purchases, because they need to add liquidity to the financial system to prevent a seize up. Well, Bitcoin and stocks are huge beneficiaries of excess liquidity. I've always liked to call Bitcoin a speculative relief valve for excess liquidity. That doesn't mean I love it or I hate it or I have any strong feelings one way or the other. It's just a fact that when there's a lot of extra liquidity floating around, these types of instruments tend to absorb it like a sponge and benefit. So on the other side of it, when there's not enough liquidity around, they tend to suffer. And we can see that with Bitcoin getting back to the lower end of the support area. I really wouldn't want to see Bitcoin break below that, because I think that would suggest we could get back down to somewhere around 66,000 pretty quickly. So we've really got to hold above 80,000. That's going to be that lower end of the range here is going to be the line in the sand. You don't want to see a weekly close above that. It suggests you could get some continuation. For now, the look belows have been bought, right? We haven't had a real closing move on a weekly basis below there. But if we do, that's when I'd be more concerned about momentum following on. Also, going back to silver for just a moment, I will say I'm still looking for $72 to $75 an ounce silver in the first quarter of next year, simply because I think that this momentum is too significant to ignore. Now, let's talk about the weekly pivots. I'm going to share this out there on social media as well. Our weekly pivots for this week, S&P 500, we're looking at 68.54.25, and NASDAQ, we're looking at 25 to 28.75. These are pivots on a swing time frame that I would be bullish above and bearish below. And I know that this week will probably just consolidate more because we've got the holidays. We've got, really a lot of the senior desks have checked out for the year, which is fine. But that gives us a sense that we probably don't have as much room for this market to move this week as we will after we get through the holidays. In fact, this is the last full trading week of 2025. Where does the time go, folks? And I'm just sharing these pivots on Twitter. All right, I just popped those out there, and we've got just a little bit before the market opens. Let's talk about some really awesome deals we've got going on. We're launching our winter sale at Traderade. So you can use the code Christmas40 for 40% off your first billing period of any of our Traderade Discord plans. Also, Bookmap has some awesome sales going on, the best of the year. You get up to 60% off of Bookmap. Visit traderade.com/bookmap. Scroll down to those special offers. Now, let's dive in to Bookmap here. And on screen, we have rolled. So another thing I wanted to talk about a little bit, just real quick, for those watching out there that are trading in futures land, I've rolled everything to the March contract. We've already seen volume shift over. In fact, yesterday, we started to see volume really shift over to that contract. So this was a little bit of an earlier roll than I usually do. I attribute it to this being a holiday week. A lot of folks are checking out, probably seeing things happen just a little bit earlier on account of that. And let me see if I can just quickly pull that up at CME so I can show you what I'm talking about. Yeah, here we go. So I'm going to put this on screen. I just got to make sure Bookmap will allow me to put things in front. There we go. All right, and we'll just zoom in just a little bit. So we can see here's a December contract. Whoopsie. Here's a December. Wow, it really likes to put that down. Here's a December contract here. And the volume, 207,000 so far this morning. March contract volume, 346,000. So that is now the most active contract. And you see the same in the NASDAQ. This is what you want to see. If you haven't rolled already, you should. You don't want to get caught out there with an illiquid spread and make it a lot harder to get out of that December contract if you're swinging it. And if you're day trading, you obviously want more liquid execution you want to make sure you get the best price discovery. So you're going to want to be in the more liquid vehicles. So that's March. That's the ESH6 contract and the NQH6 contract for the NASDAQ. We've also rolled over the SPX options visualizer as of Sunday night. So anyone out there that's using it, it is converting using those delta or the differentials between SPX and the March contract and providing those symbols in the March contract format. So let's zoom out just a little bit to this overnight session. And really, we did see a drop overnight. In fact, there were a lot of folks on socials talking about, oh gosh, it's going to be a bad trading day. We're all going to die. That sort of typical gloomy stuff that happens anytime there's a drop in the futures. I had a little fun with it because I saw Kramer talking about how there was a post from Carson Research he agreed with, and the post was saying markets typically bottom on December 15th, and then you have that sort of seasonal Santa Claus rally. And Kramer was saying makes sense. And my joke was like, well, looks like we're going to get coal this year because Kramer's going to play the Grinch and Stole Christmas because he's just such a reliable fade. It's a joke. I have no gripe against the man, really. I just like playing on the meme because it's funny. And of course, last night posted that futures went down like 0.75% on NASDAQ, but we're recovering, getting closer to the market open here. We also did get, some economic data this morning. Initially, I had a real positive reaction to that data. You can see that in this spike that happened here. We'll just zoom in just a little bit. This was the reaction to retail sales and non-farm payrolls. We kind of unraveled that reaction. You can see we've had a few tests of the point of control. The initial test before the data on large volume was rejected. Then we had the data release. We had a pretty big absorption event from sellers there, and we sold below the point of control once again. So we're just playing around. Also, there's some confluence with this gamma flip level. It's important to understand what a gamma flip means in the context of trading. So when you think about how dealers manage their order books, if you're in negative gamma territory, you're more likely to see them chase price. So a chase dynamic in negative gamma looks like this. The market's falling, dealers are selling into that fall. That exaggerates that volatility. If the market's rising, they're buying into that rise. That also exaggerates that move. That's negative gamma behavior. Zooming out, if you backtest negative gamma regimes, you see it's easier for the market to go down. You also tend to see volatility expansion for the reasons I just mentioned. On the other side of it, positive gamma tends to be the opposite. That is to say, when you have a bid in the market, market makers tend to sell into it. When you have a sell in the market, market makers tend to buy into it. So that's volatility compression. When you zoom out, positive gamma tends to be a time where it's easier for the market to grind higher. Where we are right now is sort of this neutral zone. We're just close enough to the gamma flip level that those dealer hedging flows are minimally impacted. The further away we get, the more either one of those effects, depending on which side of the flip we're on, can come into play. So that's just a little bit of context as to why the gamma flip level matters, and also why you see markets tend to flirt with it quite a lot. Because there's some structural changes that happen underneath the surface depending on how far above or below we get from it. And we're just about a minute away from the market open here. We're going to zoom in this time frame just a little bit, take it to the 20. And good morning, Loki. Today is indeed a great day. And folks out there, if you have any questions about anything, let me know. I am checking the chats. We're live on a number of different venues, so sometimes it'll take me a moment to get to your question, but I will always try to get to every question that people post. And markets are open here. Seeing a bit of a sell on the open. This is a pretty important level. I would like to see markets try to make a push back above that volatility trigger here. Should give us a little bit of support. There's some confluence with one of our intraday pivots as well. We are seeing that push so far. Let's see if it can hold. And so far, if this sort of price action is any sign, we may get a decent range. Let's see. I may end up putting my foot directly in my mouth saying that as we come right back down. But I like to see a 20-minute opening range of 15 or more handles on the S&P. To me, that gives me a sense that there's a higher chance of a dynamic trading environment. So that's one of the things I'm really looking for here. Then I also like to watch the flow and see exactly what it suggests insofar as which side has an advantage. And if we had a longer stream, we'd talk a little bit more about the initial balance, but that also does play a role in how I look at trend days. There's some statistics behind that are pretty interesting too. Basically, if you're bullish, you want to see an initial balance low and then high hit. It's more likely that you don't come back to that low if it happens in that order. And let's also switch over to the NASDAQ, take a quick look at what's happening there. I'm also going to pull up on my end just the S&P heat map to get a sense as to how this open is looking. And market on open imbalance is pretty tame. Buying 22 million at S&P, selling 20 million at NASDAQ, selling 10 million at Dow 30, and flat on the Mag 7. NASDAQ having a bit of a drop and pop, sort of like the S&P here so far. Now this gamma level, gamma 1 on NDX from the NDX options visualizer, that is a bit of a magnetic level. That is where there is a very large amount of both put and call positioning full chain, and it can often sort of pull price back to it, sort of like we're seeing now. And going back to the S&P, we're just flirting with that gamma flip level once again. And overall, really so far, not too bad of an opening range here. Looking like about 18 handles, 17 and a half. I like that. That suggests we could have a pretty dynamic trading day today. Got a little bit of a bid in Broadcom coming in after it had been sliding. It's up about 1.2%. Oracle, another one that had been beaten down. I mean, it's basically been cut in half from its highs. It's bid up 0.8% here. Tesla down just close to 2%. So a bit of a mixed bag in the S&P and some of the leadership stocks. Google down 0.8%. Nvidia down about 1/3%. And at the top level, Dow's flat, NASDAQ down 0.2%, S&P down close to 0.2%, Russell 2000 down about 0.2%. And you've got a mixed bag across all U.S. listed equities, 48% advancers, 45% decliners. So overall, not seeing either side having a huge advantage of yet. What I'd like to see is the 20-minute opening range form and the flow start to come in for SPX to get a better sense as to market direction. I will say, however, being close to that top of the range, we really do need a catalyst to break above it, especially on a closing basis. Seeing a little bit of iceberg selling up here. That 160 in red, that is an iceberg sale. That's a passive sell order. Not a very large one, but certainly worth watching to see if we have more of that type of activity come into play. Switch over to the NASDAQ here. Pretty similar look in the NASDAQ. You had that drop, pop, and now we're sort of settling, building off of Gamma 1. And we are seeing a little bit of buyer exhaustion in this move. Had a bit of a stop run here as well. So those are buy-side stops trigger from some of the shorts being stopped out. Perhaps they were selling into this prior move, and this pop pushed 115 contracts out. So essentially, they were net short. They're flattening out by having buy stops run. And this is all around the gamma flip level. We talked about that earlier, how it's often an area where markets like to sort of, I guess you could say, flirt with it. And certainly you are seeing that here. A lot of sort of price volatility right by that gamma flip. And so far, we're holding above the vol trigger level. We talked about that earlier. I would like to see price hold above that if we're going to have a bullish scenario. And Loki says silver's low key looks like a runaway market. It does. It does have that feel to it. And it's often the case that momentum and emotions run high in silver at either extreme, and you have moves get exaggerated as a result. It's not a particularly liquid trading vehicle either. Like if we go to the silver contract here, it's 4.8 thousand order book depth. It doesn't take a lot of money to move that thing all over the map. So silver is it's a lot of fun to trade if you're not putting on too much size. If you put on too much size, it becomes nerve-wracking. Ask me how I know. But it is definitely very fun to trade right now. And let's just take a look. Overall, the silver order book, just at a glance, this is something you can do with Bookmap or anything that has a DOM. It can be helpful to just getting a kind of temperature check. You've got 3,000 on bid. You've got 1.8 thousand on offer. What does that tell you right off the bat? There's more demand than supply based on this order book. So you've got folks that still want to buy silver, albeit at lower prices. You've got less folks that want to sell it at higher prices. So that typically is a good sign, especially if momentum agrees with you. And let's switch to Bitcoin for a moment just to take a look at what's going on out here in crypto land. Now we are holding above those key areas we talked about. I really don't want to see Bitcoin close the week below 83,000. particularly 83,450. That's a really important area. And we're well above that for now, but we know how quickly this thing can move. So I would still say caution is warranted in the crypto space until we really start to put in what looks like a higher low and a reversal. For now, this still could be a bear flag. It still could roll over. There's no use getting cute and getting super sized up, hoping that this is it. That's the last of the lows and we're just going to go straight higher. The overall price action and technical picture does not give us those, I would say, odds that favor upside clearly versus downside. Right now, it's more of a coin toss. I don't like trading coin tosses. I like to trade when the odds are more in my favor and the risk is way more manageable. And we are seeing a break in S&P futures lower. We're pushing below the volatility trigger level here. And this is an order book that looks a little bit different than silver, doesn't it? It's offer heavy and bid light. So sellers are showing up today. If we zoom out a little bit, we can see key 4 negative, the next area potential to support to watch based on options positioning. We can also see some bids starting to build just below price here, showing there's interest in lower prices as we make new lows. Also getting a pretty juicy opening range here, already about 25 handles. Now, one thing it is worth mentioning is for whatever reason, Tuesdays have about a 60% chance of being a double break day. So once we form the range, you can have a head fake and it can ultimately go thoroughly the other way. So just be careful. It's not quite a coin toss, 60%. So it's worth noting when those statistics are skewed that way. And we do get data. It's coming up in about a minute 40. U.S. S&P Services PMI flash. That is a data point the market's likely to key off of. You can see the order book lightening up as we approach that print. The forecast is for 54 on services and 52 on manufacturing. The prior read was 54.1 on services and 52.2 on manufacturing. So really just looking for continuation of the prior numbers. Really data heavy day today too. You've got non-farm and retail sales earlier, and now U.S. S&P services and manufacturing PMI flash. And let's check in quickly on our weekly pivots here. Our S&P pivot 6854.25. We are testing that weekly pivot here in this price action. It may provide us some support, but if we do break below and build acceptance, that is going to be pretty bad in terms of suggesting further downside to come. That data, by the way, has come over the wires. We got US S&P services flash coming in at 52.9. That is below the forecast of 54 and below the prior reading of 54.1. Also, manufacturing PMI flash coming in at 51.8, also below the forecast of 52.1 and the prior reading of 52.2. These surveys essentially tell you anything above 50 is expansion, 50 itself is flat, anything below 50 is contraction. So we still have expansion at the top level, but it is slowing. Market's not particularly thrilled with that data print, apparently making new lows here, pushing below our weekly pivot on the S&P. The NASDAQ as well having a negative reaction and also pushing below our weekly pivot. The weekly pivot on the NASDAQ, 25,228.75. So we're just tested below it, just popped back above, but we're starting to make new lows across the market. And I'll just pull in this heat map real quick to show you guys what's going on there. We can see there is some broad-based selling across multiple parts of the market. Tech is rolling over a bit here again today. We're also seeing weakness in energy, even in healthcare and defensive. So this is more of a rotate out of risk exposure entirely type of feel that's happening so far. Obviously nothing too pronounced, but we are seeing some lightening up across multiple different parts of the market. Let's move back to the S&P. We should start seeing some of these flows coming in shortly as well. And we are seeing some of those flows start to come in, leading by the calls so far. The hot call trading 968 contracts versus the hot put at 329. And a little bit of bounce off the lows as we see those flows start to come in. Getting right back up to our favorite point of indecision, the gamma flip level. Some confluence now with the refactored volatility trigger level as well. And this is some pretty wild trading. We're just kind of all over the map this morning so far. Also, just going to take a quick look across the futures complex here. Big weakness in energy. We've been talking about crude oil threatening to make new lows. It's been a sort of a theme that I've talked about on the Traderade Discord for a bit because this chart has been terrible, and it's been terrible for years. And I know there's bulls out there in the oil space, and they have a lot of convincing reasons to be bullish, and this is not to slight them in any way. This is more just a reality check that momentum, regardless of what our top-down theory may be, continues to suggest that crude is in trouble. In fact, I had meant to put a crude oil chart in the chart deck today, but time got away from me. So we'll just do it real quick here. Zoom out to this on a weekly. This is the West Texas Intermediate crude. And you can see this thing has just been rolling over. Really nothing to love about this chart. Lower highs and lower lows. And it looks like we're threatening to make a new low here on a 52-week basis. And that would just sort of continue this momentum, this downward momentum. Now, I will say with crude, I think we're closer to a low unless we have a really big economic slowdown happen. I think we could base out in the low 50s in West Texas Intermediate crude. I don't think we'll go too much below there, because once we start to get down to these levels, you actually start to see supply dry up a bit. You start to see some of the drillers reduce their activity. So it's a bit of a self-correcting phenomenon, again, without a sort of economic rug pull. And look at this market. It's now breaking to new session highs. We just put in the 20-minute opening range, and it's a juicy one. It's about a 29 handle opening range. Haven't seen one that big in some time, which suggests we could have a pretty dynamic trading day ahead. And let's zoom out here, see what we get from the flows. Definitely a lot of hedging going on here. The hot put, 7,000. That's more active than the warm call and hot call combined, which suggests that some of this morning flow that was pulling us lower, likely some hedging flows. When you see that big put push early in the morning, it's often hedging flow that is leading that. And it could be a bit of hedging ahead of CPI Thursday. This is such a data heavy week. NFP, retail sales, we've got home data, we've got the S&P flash PMIs. We also have CPI on Thursday. So perhaps some of that initial draw was that just-in-time hedging flow ahead of CPI. What I mean is, if you've got folks that all they do is sell vol all day long, you're trying to buy insurance, and your insurance premium is the same as that vol, why wouldn't you wait till the last minute? A, because you might get a better deal on that insurance, that, put that you're buying to hedge out your longs. But B, why would you do it earlier if other folks are just going to sell down that insurance that you're taking out? So you see more and more of that put flow come in a day or two, or even sometimes the same day if it's during the trading hours. You see more of that just-in-time hedging. So I'm going to speculate that some of those more aggressive put sweeps in SPX this morning were just that, which would also explain why we're kind of acting like a beach ball underwater, that once that hedging flow starts to dry up, the market feels like it wants to try to make a push higher here. But again, another rejection at that point of control. So contain our optimism for now, or as Larry David's show says, curb your enthusiasm. And we do have a pretty big area of put implied support at 67.80. And of course, 6,800. These are SPX levels, just delta of about 62 to ES there. And Kemi's saying, beach ball underwater, beautifully put. Thank you. And Loki says, thanks to FinTwit, I've learned to never trade silver. It's probably wise to buy the real thing. I would just take exception to say it's not something you really want to trade with size, but I don't have any problem swinging silver based on prevailing momentum trends. In fact, that's been one of my trades this year. It's been pretty much on for, like 7+ months, and I've had no reason to exit yet. I also have silver miners, I have gold miners, juniors, etc. I would say it's much more risky to trade silver with leverage. If you're trading silver with leverage, you're usually going to have a bad time because the moves get pretty exaggerated. Now, on my Discord, I talk about platinum, palladium, copper, gold, silver, oil, Bitcoin, pretty much all the stuff that has momentum that's worth trading. We're talking about that all the time. And we've been early on some of these bigger moves as well. So I don't talk about it on here as much because I just simply don't have the time and the bandwidth in like the periodic live streams that I do to get into the nitty gritty of all the commodities. But perhaps as time goes on, I'll do some more of that type of content. And we're getting right back up to the upper end of this trading range. We can see the gamma flip level has been refactored a bit higher as well due to some of the options positioning changes that the SPX options visualizer has factored in. So now we have the big trifecta. Up here lies the point of control, VWAP, that's this white horizontal line here, and the gamma flip level. So we could reasonably expect that 68.7950 is going to be the line in the sand. What we would want to see for a bullish scenario is a break above there, let's say to 68.85 or higher, and acceptance built for at least 5 minutes to suggest we could have more continuation to the upside. We also do not want to see a retest and break below the lows. That throws any bullish scenario out. If you want this thing to be a bullish resolution, you really want to see more range expansion to the upside here. Otherwise, we threaten one of those double break Tuesdays. And folks, if you want to learn more about the SPX options visualizer, you can visit traderade.com/SPX. We're going to be expanding this tool set to the NASDAQ, the Triple Q, SPY, and the Mag 7 stocks, as well as stocks like Broadcom, Netflix, etc., coming soon in 2026. So stay tuned for that. Works on Bookmap, Motive Wave, and we'll be bringing it to other chart platforms, I should say, like Sierra Chart soon as well. And if you'd like to get up to 40% off of Traderade, visit traderade.com, learn more about what we offer, and once you get to checkout, use the code Christmas40. For Bookmap, if you'd like to get up to 60% off, they're having their best sale of the year till the end of December, as I understand it. You can visit traderade.com/bookmap, scroll down to the special offers to take advantage of these exclusive deals. And as always, I will be back next Tuesday, 9 a.m. Eastern. It's going to be a really interesting journey as we close out the year here. We've got seasonality on one side, suggesting that we should move higher above this range, but we also have this very formidable trading range, and we don't yet have a positive catalyst to break to the upside. We similarly don't have a negative catalyst to break to the downside. So are we going to be range bound to end of the year? Time will tell, but we do need to see a significant positive catalyst, in my view, to break the top of that range and be able to hold up there, not just have it be a sort of peak above. And as we're wrapping up this stream, we can see we're getting to the trifecta level where we've got the point of control, VWAP, and the gamma flip. That's around 68.79.50. Watch that level closely. That is the key decision zone for me today. You've got a lot of market-generated data saying this is the level to watch. We want to see a break above for bullish continuation. If you don't, we could get right back to the lower end of the range. And if we do break below the lower end of the range, that suggests pretty strongly we could get some continuation lower. Let's have one quick look at the flow before we wrap up. Hot put, 9,000, warm and hot call, 10,000 combined. So we are seeing call flow pick up, but put flow is still dominating this tape. I want to thank everyone for tuning into this week's episode of Back to the Futures. If you missed it or you want to watch it again, it is going to be reposted on the Bookmap YouTube as well as that of my own. You can also find it on X, Substack, Twitch, Kick, and everywhere else we're live. Talk to you soon, folks. Have a great rest of your trading week.